Everybody, it's Shannon from alphatrends.net. Today's Friday, the 2nd of December. I hope you had a good week of trading. The market did pull back a little bit here. S&P 500 lost a little less than 1% for the week, and some of these other markets got hit a little bit harder, such as the semiconductors and biotechs. Oil had a big week, and bonds were starting to maybe stabilize a little bit, but they were still down on the week. So let's take a look at the charts, and we will discuss the action here as it is presently showing it to ourselves. The S&P 500 on the weekly time frame came down to the prior breakout level that we had seen from earlier this year. So when we go down to that daily time frame, you can see that the prior resistance back here in August and September has so far at least held as support. But as I pointed out in the Wednesday video, that we are below a declining 5-day moving average. So we continue to look at this market from an intermediate term perspective as guilty till proven innocent, meaning that we don't trust rallies to hold until we get back above that 5-day moving average, and that 5-day moving average is flat to rising, and that's just a very simple defensive mechanism within an overall uptrend. We never know if these pullbacks will continue to pull back, and that was the top. People love to focus on trying to pick the tops. I'd rather look at it as one piece at a time, that we had seen a beautiful pattern of higher highs and higher lows above that rising 5-day moving average over the last month, and that pattern came into jeopardy a little bit earlier in the week, and then as we saw that it broke down below that, now the sellers are in control, and it's guilty till proven innocent on the intermediate term time frame. If you're a longer term investor, this means very little. If you're a short term trader, then day trading on the short side is okay. Maybe small shorts, in the index, that is, are okay. But there's still a lot of great individual stock ideas out there, and that's what we always continue to focus on at Alpha Trends. Let's take a look at the Nasdaq, because the Nasdaq lost a little bit more ground. As we've been talking about, we're in this bigger box. I was expecting that it seemed likely we would hold in this area right in here. Obviously, we broke below it. So my expectations, the market doesn't care about what I expect or think will happen, which is why I don't bet on what I think will happen, but instead I look at the market objectively with tools such as what's the direction of the intermediate term trend, lower highs and lower lows. And when we broke that support over here this week, that's when the market became guilty till proven innocent. And I was looking at this 50-day moving average as a potential area of support, but it's not something I want to buy until there's actual evidence that the buyers have in fact gained control. We don't have any of that evidence here this week, so let's back it up a little bit, and you can see the bigger band of support should be found down near 113.5 to 114, but the bigger picture on the Nasdaq is still range bound within a primary uptrend bull market here. So we've got a rising 20, 30, and 40-week moving average. That tells us the longer term trend is still higher, and when we back this weekly chart up, this consolidation is either distribution before a reversal, or more likely it is consolidation before it continues higher. And as the market breaks down in the intermediate term, we stand aside with our bullish bias, and we say let's wait for actual evidence before we get involved on the long side. Let's talk about the biotechs here, because I present these as a potentially bullish for this week in last week's video. Wednesday, I did an update, which I hope you had seen. Put that on YouTube. And by the way, if you follow me on YouTube, make sure you look at alphatrends.net. I've got a webinar on Tuesday of next week with a real good friend of mine, best trader I know. This guy broke out massively this year. He has million-dollar days up and down. He's been making just a boatload of money like you wouldn't believe. It's going to be an opportunity for you to ask him questions. He'll tell you how he handles it emotionally, and of course talk about the money that he's making and some of his big losing trades. He's had million-dollar down days as well, but he's going to be on a webinar that you can sign up for at Alpha Trends. It will be recorded, but it will only be viewable if you actually sign up for it. So the biotechs, what we were looking for here was the potential of a reversal. As we always say, when the direction of the 5-day moving average is lower, it's guilty till proven innocent. We don't want to buy it until the 5-day moving average has flattened out, and then the market has the opportunity to break resistance and make a higher high in the intermediate term, and then we buy it with a stop below the immediate, most recent relevant higher low for the time frame we're looking at. So we were looking for stabilization in here near that 50-day moving average and near that year-to-date volume weighted average price. But what did we see happen? We broke through those levels, and there was no reason at all to be a purchaser. Looking for the potential, no problem. You don't lose money looking for potential. You don't lose money waiting for evidence that the buyers regain control. Next week, maybe these guys can turn. Maybe they come up like this and do something, similar to that, and then they break higher. It's at that point I would much rather pay 285 than 270 because I want to buy when the momentum turns and there is actual evidence that the buyers are in control. So the biotechs didn't work. Was it a bad call? No, because it wasn't a call. It was an opportunity to look for that didn't materialize. And that's what the market is about, is anticipating all potential scenarios, waiting to participate with your cash until you have actual evidence that the price confirms what the scenario is that you're looking for. The Russell 2000 lost a little bit of ground in here. As I had pointed out, we've got a couple of important levels down below in this area right here at about 127. Let's look at the 30-minute time frame, and I'll point those out to you. So we had basically from this gap higher, the essence of the move. We had seen some distribution and then finally breaking down below the 5-day moving average and being trapped under that 5-day moving average. So what we see now is a 38.2% retracement of this move to this peak, brings us down right here, 38.2 to this level. What else we see here is when we take this volume weighted average price tool and snap it on there, that's where the volume weighted average price from that move began. And then when we look at the daily time frame, you can see right in there we've got a rising 20-day moving average. Now that's a potential level of support. That means that it wouldn't be a surprise for it to come down to that level while we're below this declining 5-day moving average and while we're still making a pattern of lower highs and lower lows. But if instead we see the market reverses and turns back up and pulls back a little bit in here, and then we break past resistance, well, that's the point where you get bullish. And then you would set your stop underneath here, and the 5-day moving average would start to circle back around like this. So that's the scenario we would be looking for further bullishness in the Russell 2000. That's the anticipated bullish scenario. It doesn't mean that's what I'm expecting. I'm saying here's a potential scenario. Until that something like that happens, what we have right now is actual evidence that we have lower highs and lower lows below a declining 5-day moving average, which means we do not trust rally attempts for more than just little short-term intraday trades, if that's your time frame. Semiconductors pulled back pretty deep, as we mentioned. In Alpha Trends, we were talking about getting bullish and long above this level here with a stop at that point. This is a trade I've been highlighting the last couple weeks, and then we set our stop under here, and we were out. And on the Wednesday video, I said, be careful with these semiconductors. They are now guilty till proven innocent because they're below the declining 5-day moving average. Now, I didn't expect a decline like this, but that's not the point. The point is, if you're if you're out of your long and you avoid this pullback, number one, that is worth its weight in gold. Secondly, if you were getting aggressively short, well, that's a great trade, but the primary trend is higher, so it's not my bias to try for those trades. Everyone has to figure out what makes most sense to them in terms of time frame, risk management, and that sort of thing in the market. But if you base that around a fundamental structure of how the market actually works, then you're going to be able to make those decisions objectively. And that's what we strive to do each and every day at Alpha Trends. Let's take a look at Apple. Let's not look at Apple. Let's look at those bonds. This was kind of funny. Yesterday, I put on Twitter a chart of the bonds showing this 5-year trend line that we can even go back to a monthly time frame, but this is an important trend line that started in 2011 and then hit again in 2014, and we were rapidly approaching that after a big downtrend. Now, I wasn't calling for a bottom. I said, here's a potential level of support. This is something we should be looking at for a couple of reasons. One, because we had that trend line. Two, because we had this, the last time we touched the trend line and rallied up to that 143-ish level, well, a 61.8% retracement brings us right into this area. And it's also been an area that's been heavily contested over the years as support right in here, and that, as resistance over here, support, and then as a resistance, and then as support. Now the potential becomes support again. So the bonds have been in a horrific downtrend. They just happened to bounce almost exactly at the time I had posted that on online, which was right around in this area right here. But the point is, I wasn't calling a bottom. I was pointing out a level of interest. Just as I wasn't calling the biotechs are going to rally, it's a level of interest. Then you have to decide what's your time frame. Realistically, on a 30-minute time frame, they're still broken. They're still below a declining 5-day moving average. So I would not trust rallies in the bonds still. They're deeply sold off, and maybe they get a bounce from here, but that's not the point. We also saw again that oil had a huge week, up 11% this week. So next week on Alpha Trends, we've got a number of stocks that we're going to be looking at in that oil group for continuation. They've pulled back a little bit. They're coming into a place where they're starting to make a good risk reward. But this week we had great trades in IDTI. We got out of this stock. Our last sale was right up in here at this circled area. We purchased the stock over here. We got out there, and then it just completely round tripped. So there, that's what disciplined trading is about. We were short shares of DXCM, and this stock fell apart beautifully for us. We shorted it right here, and we covered it. I think our best cover was right around in that area. The point is, have a disciplined approach to trading. Come to that webinar next Tuesday. Make sure you check out the classes I have at alphatrends.net as well, and I hope you have a good